Before we begin, let me ask you something important. Do you believe the silver market is quietly preparing for one of the biggest financial shifts in decades, or do you think the recent volatility is just another temporary market move? Comment your answer below, because what is happening in silver right now is something very few people are paying attention to, and yet it could have enormous consequences for investors around the world. Right now, something unusual is unfolding inside the silver market. Most people have not noticed it yet. The large financial networks are barely mentioning it. Television analysts are busy discussing stock market rallies, bond yields, or the latest cryptocurrency trends. Meanwhile, behind the scenes, a dramatic change is taking place in one of the most important commodity markets in the world. The institutions that have dominated silver trading for decades are slowly stepping back. The biggest short sellers, the players who held enormous bets against silver for years, are beginning to close their positions. They are not just making small adjustments. They are retreating in a way that has not been seen in a very long time. And when the most powerful traders in a market suddenly begin backing away from positions that defined the market structure for years, it is a signal that deserves serious attention. Let me explain what recently happened. According to data highlighted by former financial journalist Willem Middelkoop, the four largest short sellers operating in the silver futures market on the COMEX exchange have reduced their short exposure dramatically since 2024. In fact, nearly half of their total short positions have already been closed. Think about that for a moment. Nearly half. These are not small trades or short-term speculation. These were massive institutional positions that shaped the silver market for decades. The fact that these positions are now being unwound tells us that something deeper is changing beneath the surface. Whenever the largest participants in a market start rushing toward the exit, the obvious question becomes, what do they see coming? To understand the significance of this development, we need to look at how the silver market has operated for many years. For decades, the silver market has been dominated by a small group of extremely large traders holding concentrated short positions on the COMEX futures exchange in Chicago. These short positions have been the center of controversy for a long time. Critics have repeatedly argued that these large positions placed downward pressure on silver prices and prevented the metal from rising to levels that reflected its true value. The pattern appeared again and again, and whenever silver prices began moving higher, large traders would increase their short positions, creating enormous selling pressure in the futures market. That selling pressure often overwhelmed buyers and pushed prices back down. It happened when silver surged toward $50 in 2011. It happened again during the global financial uncertainty in 2020, and it continued through multiple rallies over the years. Every time the metal tried to break out, the short side pushed back. But today, something different is happening. The traders who once defended those positions are now covering them. They are reducing exposure. They are stepping away from trades that once gave them enormous control over the market. If this process continues, it could fundamentally change the dynamics of silver pricing. Before we continue, I want to know where you are watching from today. Write your city and country in the comments section. Are you watching from the United States, Canada, the United Kingdom, Australia, India, Germany, South Africa, or somewhere else entirely? The reason I ask is simple. What is happening in the silver market right now is not limited to one region or one financial center. The structural shifts unfolding today have global implications for investors everywhere. Silver is traded worldwide. It is used in industries across continents, and the changes taking place right now affect everyone involved in precious metals. Now let's examine the data that first revealed this shift. Willem Middelkoop recently shared a chart comparing the short exposure of the largest traders across multiple commodity markets. The chart measured how many days of global production would be required to cover the short positions held by the four largest traders and the 8 largest traders in each commodity. When you look at this chart, one market immediately stands out: silver. Among all the commodities shown on the chart, silver and platinum displayed the highest levels of concentrated short exposure relative to global production. In the silver market, the 8 largest traders collectively hold short positions equal to more than 100 days of global silver production. Think carefully about what that means. It means that just 8 traders have held short exposure equivalent to more than 100 days of everything the world produces. Even when you narrow the focus to only the 4 largest traders, their combined positions represent roughly 70 days of global production. Compared to markets like oil, wheat, copper, or coffee, the concentration of short exposure in silver has historically been far higher. This concentration is the reason why discussions about a potential silver short squeeze have existed for so many years within the precious metals community. When enormous short positions are concentrated in a small number of hands, the market becomes vulnerable to sudden disruptions. If supply tightens, if physical demand increases sharply, or if confidence shifts, those short sellers may be forced to buy back their positions. And when that happens, they become buyers, very large buyers. Closing a short position requires purchasing silver contracts. When the positions involved are measured in millions of ounces, that buying pressure can push prices sharply higher. Now consider what is happening today. Those concentrated short positions are shrinking. Data shows that the four largest traders have already reduced nearly half of their COMEX short exposure during the past 2 years. This is not speculation. This is not wishful thinking from silver enthusiasts. The actual trading data confirms that the largest participants are reducing their exposure. Which raises an obvious question. Why now? Why are these traders covering positions that they defended for decades? Several powerful factors appear to be converging at the same time. The first factor is the physical supply situation. The silver market is now experiencing its 6th consecutive year of supply deficit. Let me repeat that because it is extremely important. For 6 straight years, global demand for silver has exceeded the amount of silver produced by mines. The world has been consuming more silver than it has been producing, and according to projections, this imbalance is not expected to disappear anytime soon. Estimates suggest that the supply deficit for the coming year could reach approximately 67 million ounces. Even if global silver supply rises to around 1.05 billion ounces, which would represent the highest production level in nearly a decade, it would still fall short of total demand. The structural reason behind this imbalance is something many investors overlook. Unlike gold, most silver production does not come from primary silver mines. Instead, the majority of silver is produced as a byproduct of mining other metals, particularly copper and zinc. When companies extract copper or zinc from the ground, silver often appears alongside those metals. As a result, silver supply is heavily dependent on the economics of those other mining operations. This creates an unusual situation. Even if silver prices rise significantly, mining companies cannot immediately increase silver production. To produce more silver, they would have to increase copper or zinc mining. And that decision depends on the prices and demand for those metals, not silver itself. This means the supply response in the silver market is slow and limited. In markets like oil, higher prices can quickly lead to more drilling. In agriculture, higher prices can encourage farmers to plant more crops. But silver is different. Its supply is structurally inelastic. Mining output cannot easily expand in response to rising prices, which allows supply deficits to persist for long periods. Over time, persistent deficits gradually reduce above-ground inventories. Eventually, the market reaches a point where available supply becomes tight enough to trigger rapid price adjustments. Now let me ask you another question. How long have you personally been following the silver market? Are you someone who recently started learning about precious metals and the forces that influence supply and demand? Or have you been watching this market for years, collecting physical silver and observing these supply deficits accumulate over time? Share your experience in the comments. I always find it fascinating to see how people discover the silver market and what first sparked their interest in it. Understanding the community watching these discussions helps reveal how awareness of precious metals is spreading around the world. Now let's talk about the other side of the equation, demand. Because the forces driving demand for silver today are powerful, structural, and accelerating. And this is where the story becomes even more interesting. Silver plays a critical role in the global transition toward cleaner energy. Modern solar panels rely heavily on silver because of its exceptional electrical conductivity. The photovoltaic cells used in high-efficiency solar panels require silver to transport electricity effectively. Manufacturers have attempted to reduce the amount of silver used in each solar cell, but the metal remains essential for maintaining performance. Some of the most advanced solar technologies currently being deployed actually require higher silver content to achieve maximum efficiency. At the same time, global solar power capacity continues to expand rapidly. Industry projections indicate that worldwide solar installations are growing at roughly 15% per year. That expansion translates directly into rising demand for silver. And solar energy is only one part of the story. Electric vehicles represent another major source of demand growth. Compared with traditional gasoline vehicles, electric cars use significantly more silver. Electrical contacts, charging systems, battery management systems, and internal wiring all rely on silver components. On average, an electric vehicle contains nearly 80% more silver than a conventional internal combustion engine vehicle. As transportation gradually shifts toward electric power, the silver intensity of the global vehicle fleet is increasing. And then there is the technology revolution currently unfolding around artificial intelligence. AI systems require enormous computational power. That computational power requires data centers filled with advanced electronic equipment. Those facilities contain vast amounts of electrical infrastructure, circuits, connectors, and cooling systems. Silver plays a crucial role in many of these components. The expansion of cloud computing, 5G networks, and the rapidly growing Internet of Things is adding another layer of industrial demand for silver. When you combine solar power, electric vehicles, artificial intelligence, and traditional industrial uses, a remarkable statistic emerges. Nearly 60% of global silver demand now comes from industrial applications. This means silver is no longer simply a precious metal used for coins, jewelry, or decoration. It has become a critical industrial material embedded deeply within the technologies that power the modern economy. And that transformation has profound implications for the future of the silver market. And this transformation is one of the most important reasons why the silver market today looks very different from the silver market of several decades ago. In earlier periods, silver demand was dominated by jewelry consumption and monetary investment. Coins, decorative objects, and occasional bursts of investor demand drove the market. But the modern world has introduced entirely new forces that continuously pull silver into manufacturing processes where it cannot easily be replaced. When silver becomes embedded in industrial production, it changes the entire structure of demand. Jewelry can be recycled, decorative silver can return to the market, but silver used in solar panels, electronic circuits, and advanced technologies often becomes difficult or uneconomical to recover. Once it is built into devices and equipment, much of it effectively disappears from available supply. That means industrial demand has a very different impact on long-term availability. Another development that many investors have not fully recognized is the growing strategic importance of silver at the national level. Recently, the United States government officially designated silver as a critical mineral. This classification is not symbolic. Critical minerals are materials considered essential for national security, economic stability, and technological development. Governments place resources on this list when they believe supply chains could become vulnerable. Silver's inclusion on that list reflects how important the metal has become for advanced technology and energy infrastructure. But the story becomes even more interesting when you look at where the global supply of refined silver is concentrated. China currently controls approximately 70% of refined silver supply worldwide. 70%. In a world where geopolitical tensions between major powers continue to increase, this level of concentration introduces a potential vulnerability. Trade disputes, export controls, and strategic competition between countries have already affected several other critical materials. China has previously restricted exports of certain rare earth elements and strategic metals when political or economic tensions escalated. If a similar situation ever occurred with silver, the consequences for global supply chains would be immediate. Manufacturers that rely on silver for solar panels, electronics, and advanced infrastructure could suddenly face severe shortages. This geopolitical dimension adds another layer of complexity to the silver market, and it connects directly to another major change that many retail investors are only beginning to notice. For decades, the global price of silver has been primarily determined on the COMEX futures exchange in Chicago. The futures market became the central location where institutional traders, banks, hedge funds, and commercial participants bought and sold contracts representing silver. These contracts allowed traders to speculate on price movements without necessarily dealing with physical metal. As a result, the price discovered on the futures exchange became the reference price used throughout the world. Dealers selling physical silver coins and bars would usually quote prices based on the COMEX spot price plus a premium. But something important has been changing in recent years. Open interest on COMEX has been gradually declining. Trading activity is no longer as dominant as it once was. At the same time, exchanges in Asia are becoming more influential in determining the global price of precious metals. The Shanghai Gold Exchange and the growing silver markets connected to Shanghai are playing an increasingly significant role in price discovery. Trading volume in these eastern markets has been expanding while Western futures activity shows signs of slowing. This shift matters because the participants in these markets behave differently. In Western futures markets, much of the trading involves paper contracts. Traders frequently speculate on price movements without any intention of taking delivery of physical metal. But in the Shanghai market, physical demand plays a much larger role. Chinese buyers often purchase silver for industrial use, jewelry production, and long-term investment rather than purely speculative trading. When a market connected to physical demand becomes more influential in price discovery, the price of the metal begins to reflect real supply and demand conditions more closely. That represents a major structural change. If Western futures markets previously allowed large traders to suppress prices through concentrated short selling, and if global price discovery gradually shifts toward markets where physical demand dominates, the ability to control prices through paper trading becomes weaker. In other words, the rules of the game begin to change. This is one possible reason why the largest short sellers have started reducing their exposure. They may recognize that the environment that once allowed them to dominate the market is slowly disappearing. The center of gravity in the silver market may be moving from west to east. And fighting against a physical market driven by real demand is far more difficult than managing a paper futures market. Now let's shift our focus to recent price movements, because the silver market has experienced extraordinary volatility. At the beginning of the year, silver reached a historic milestone. The price surged to $121 per ounce, To understand the significance of that number, it helps to remember that for more than 40 years, the previous record had been around $50 per ounce, established during the dramatic market spike of 1980. For decades, that record remained untouched. But in the previous year, silver finally broke through that level. And then, shortly afterward, the price accelerated dramatically to $121. However, the move did not last. After reaching that peak, silver experienced a sharp correction. Prices dropped roughly 40% in a relatively short period of time, falling from $121 to a range around $84 per ounce. That type of decline naturally created concern among investors. Large price swings attract headlines, and dramatic pullbacks often create fear in the market. But corrections like this are not unusual in commodities, especially in precious metals. Markets rarely move in straight lines. After a powerful rally, consolidation and correction are often necessary to stabilize the market. When a metal rises rapidly from below $30 to more than $120, the market needs time to digest those gains. Speculative positions accumulate during rapid rallies. Traders chasing momentum enter the market, hoping to capture quick profits. Eventually, the market must shake out those positions. That process can be uncomfortable, but it often strengthens the long-term structure of the trend. In the case of silver, the correction brought prices down to the $80 region, where buyers began stepping back into the market. That level has started to emerge as an important area of support. During recent trading sessions, silver has fluctuated between approximately $83 and $84, recovering modestly from recent lows. The market appears to be stabilizing and building a base. Technically speaking, consolidation phases like this often occur before the next major directional move. One level that analysts are watching closely is the area around $85.50. If silver closes above that level on shorter-term charts, it could trigger additional buying pressure. Technical traders often interpret such breakouts as confirmation that a new upward trend is beginning. If that scenario develops, analysts suggest the next potential price target could appear around $91. Beyond that, the psychologically important level of $100 would again come into view. On the other side of the equation, the $80 region remains a critical support zone. If prices were to fall below approximately $80.50, it could open the door for a deeper correction toward the low 70s. But many analysts believe that dips into the low 80s are likely to attract institutional buyers, particularly given the ongoing supply deficit and strong industrial demand. Another factor influencing silver prices is the broader geopolitical environment. Periods of uncertainty often increase demand for precious metals because investors seek assets perceived as stores of value. In recent months, global tensions have remained elevated. Conflicts in strategic regions continue to disrupt supply chains and energy markets. Political uncertainty and shifting alliances have increased volatility across financial markets. Historically, environments like this tend to increase interest in hard assets such as gold and silver. Investors seeking protection against instability frequently allocate a portion of their portfolios to precious metals. This safe haven demand adds additional support to prices. Now let's consider what major financial institutions are saying about the future of silver. Opinions vary widely, reflecting both the potential opportunity and the uncertainty surrounding the market. Some forecasts remain relatively conservative. For example, analysts at J.P. Morgan have suggested that the average silver price could remain near $81 per ounce. In their view, current prices already reflect many of the supportive factors in the market. This type of prediction represents the cautious perspective often favored by large institutions. Conservative forecasts minimize the risk of making bold predictions that later prove incorrect. But other institutions have offered much more optimistic outlooks. Citigroup analysts, for instance, have suggested that silver could reach $100 per ounce in the near future and potentially rise to $110 shortly afterward. Their reasoning focuses on the tightening physical supply situation and the continued reduction of short positions in major trading markets. They believe that these factors could push prices higher as the market attempts to rebalance supply and demand. Even more striking are the scenarios being discussed by analysts at Bank of America. Their research explores potential price targets ranging from $135 to levels exceeding $300 per ounce. At first glance, those numbers might sound extreme, but the reasoning behind them involves a well-known metric used in precious metals markets, the gold-to-silver ratio. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold. Historically, the ratio has fluctuated significantly. At the moment, with gold trading around $5,100 per ounce and silver near $84, the ratio is approximately 60 to 1. In other words, it takes about 60 ounces of silver to equal the value of 1 ounce of gold. However, historical averages have often been lower. Over long periods, the ratio has frequently hovered closer to 50 to 1. During strong precious metals bull markets, the ratio has sometimes compressed to 30 to 1. and at certain extreme moments in history it has even approached 15 to 1. If gold remained around $5,100 and the ratio fell to 30 to 1, silver would reach roughly $170 per ounce. If the ratio dropped further to 20 to 1, silver would approach $255. And in a scenario where the ratio reached 15 to 1 while gold continued rising, silver prices above $300 could become mathematically possible. These projections do not guarantee that such prices will occur, but they illustrate how dramatically silver could move if historical relationships reassert themselves during a strong precious metals cycle. The fact that major institutions are discussing these possibilities shows how seriously analysts are beginning to evaluate silver's long-term potential. Now think about what all of these forces represent collectively. Large short positions are shrinking. Physical supply deficits have persisted for years. Industrial demand is expanding rapidly through solar energy, electric vehicles, and advanced technology. Geopolitical tensions are supporting safe haven interest, and global price discovery may be gradually shifting toward markets more closely tied to physical demand. When these factors combine, they create a market environment that is fundamentally different from the one that existed in previous decades, and that leads directly into the next critical part of the story. And when all of these forces begin interacting at the same time, the silver market starts to look very different from the way it appeared in previous decades. For years, many investors viewed silver primarily as a speculative metal that moved unpredictably and often disappointed those expecting explosive gains. But the environment developing today suggests that silver may be entering a completely different phase, one driven less by speculation and more by structural changes in the global economy. One of the most important factors supporting this shift is the continued expansion of industrial demand. Earlier, we discussed how solar energy has become a major driver of silver consumption, but the scale of this demand deserves even deeper attention. Around the world, governments and energy companies are racing to expand renewable power capacity. Climate commitments, concerns about energy independence, and technological improvements have accelerated investment in solar power infrastructure. Each new solar installation requires photovoltaic cells that rely on silver for electrical conductivity. Even small changes in the number of solar panels installed globally can translate into millions of additional ounces of silver consumption. Manufacturers have certainly tried to reduce their reliance on silver by improving efficiency and reducing the amount used per solar cell. Engineers call this process thrifting, but there are limits to how far thrifting can go. If too little silver is used, the performance and efficiency of the solar cells begin to decline. In fact, some of the newest high-efficiency solar technologies, particularly TOPCon cells that are becoming increasingly common in large solar installations, require higher silver content than previous designs. This means that technological progress does not always reduce silver demand. In some cases, it actually increases it. So even as engineers attempt to optimize material usage, the rapid expansion of solar capacity continues to push overall silver demand higher. Electric vehicles create a similar pattern. Traditional gasoline vehicles contain relatively small amounts of silver because their electrical systems are simpler, but electric vehicles rely heavily on advanced electronics, battery management systems, high-voltage connectors, and charging infrastructure. All of these components benefit from silver's excellent conductivity and durability. As a result, the average electric vehicle contains significantly more silver than a conventional car. Estimates suggest the difference may be close to 80% more silver per vehicle. When multiplied across millions of vehicles being produced each year, that difference becomes enormous. The transition toward electric transportation is accelerating in many parts of the world. Government incentives, environmental regulations, and improvements in battery technology are encouraging manufacturers to increase production. As this transition continues, the total amount of silver embedded in the global vehicle fleet will steadily increase. China currently leads the world in electric vehicle adoption. Chinese manufacturers have aggressively expanded production capacity and introduced new models at rapid speed. This leadership has important implications for the silver market because it means China's domestic demand for silver is rising quickly as well. The more silver that Chinese industries consume domestically, the less may be available for export to other countries. That dynamic could eventually tighten global supply even further. And then there is the newest driver of industrial demand: artificial intelligence. AI technology has advanced at an extraordinary pace in recent years. Machine learning systems require immense computational resources, which has triggered a massive expansion of data center infrastructure around the world. These facilities house thousands of servers, networking systems, cooling systems, and electrical distribution equipment. Silver is present throughout this infrastructure. Electrical connectors, circuit boards, switches, and specialized components frequently rely on silver to ensure reliable performance. As AI applications expand into industries ranging from finance and healthcare to manufacturing and transportation, The demand for computing power continues to grow. That means more data centers, more electronics, more silver embedded in technological infrastructure. The combined effect of solar energy, electric transportation, artificial intelligence, telecommunications networks, and traditional industrial applications is transforming the silver demand profile. Today, industrial uses account for roughly 60% of global silver consumption. That figure alone illustrates how deeply silver has become integrated into the technologies shaping the future economy, and yet supply remains constrained. We already discussed how silver production is largely dependent on mining operations focused on other metals. This structural limitation prevents the supply side from responding quickly to rising demand. When demand accelerates while supply remains slow to adjust, the imbalance creates persistent deficits. According to current estimates, the silver market has already experienced 6 consecutive years in which demand exceeded newly mined supply. Inventories accumulated in previous years have helped fill the gap, but those reserves cannot last forever. Over time, continued deficits gradually reduce the amount of silver available above ground. Eventually, markets reach a point where the remaining supply becomes tight enough that prices must adjust upward to restore balance. That brings us back to the question many investors are asking right now. If the long-term fundamentals appear so strong, why did silver fall from $121 to the mid-80s in such a short period of time? The answer lies partly in the nature of precious metals markets. Silver has always been volatile. Even during powerful bull markets, sharp corrections frequently occur. Prices may surge rapidly as investor enthusiasm builds, then retreat sharply when speculative traders take profits, or when market sentiment shifts temporarily. Historical examples demonstrate this pattern clearly. During the precious metals boom of the 1970s, silver experienced multiple corrections ranging from 30% to 50%. Each correction shook out investors who lacked conviction, yet the long-term trend continued higher until the metal eventually reached its famous peak near $50 in 1980.